Let's bring in Truist co-CIO Keith Lerner today and LinkedIn's chief economist Karen Kimbrough. Great to see you guys. Appreciate the time on a holiday Friday. Keith, do you think that Nord Stream is worth the offset to NFP that we saw intraday today?
Yeah. Well, first, great to be with you, Carl. Listen, it's the last day before a long weekend. There's this geopolitical uncertainty out there. So why go into the weekend long if you're a trader with the uncertainty? And there's not a catalyst that we can point to for like beginning of next week for this market to move higher. So listen, I think it makes some sense. It's just a little bit disappointing to see such a reversal, and that did happen around this news out of Nord Stream. So I think that had some impact on it. But I also think more like traders are closing up their books and going to start over next week.
Yeah, that's certainly how it feels a little bit on the floor here, Karen. I do wonder, as for the jobs print itself, those who wanted to argue that it was net dovish for the Fed, is there enough in there to think they're on track?
I don't think there's enough in there to call it one way or another. The Fed likes to have a couple of data points under their belt before they make a big decision. So I think they're going to keep watching the data before they're sure. But to be clear, this was a pretty solid report. We were happy to see it. It mirrored what we see at LinkedIn, which is, hiring is up from last month. And this is the first time we saw nearly 7% hiring pace among our members since April. So definitely a positive sign that the labor market is in good shape. And if anything, it kind of opens that path for the possibility that the Fed can, get through here without causing a recession.
Right. Journal did a piece following the print today, Karen, basically arguing that the conversation is still very much about 50 or 75 basis points. We're awaiting CPI on the 13th. Does it change your view about the terminal rate? Because I think the market may be a little bit tired of arguing 50 or 75.
I don't think it does. I think whether they do 50 or 75, they know they want to get as much done as possible and go early or early-ish, if we can call it that. Because ultimately, the longer they wait, the harder it's going to get. We heard Jay Powell say that. And from our perspective, the labor market continues to be probably something that's actually kind of helpful. I know they're worried about the imbalance between labor supply and labor demand, but we're seeing employers continuing to hire, focusing on what skills they can get through skill-based hiring of employees. And we're seeing job seekers coming off the sidelines. That's what you saw in the report. You saw unemployment rate go up. That's a sign that people are re-entering the labor market, looking for jobs. So all in all, really, really healthy place for the Fed to be. And whether they do 75 or 50 doesn't really change my view. I think they still have some ways to go.
All right. Hey, finally, Keith, just on the indexes, it doesn't sound like you're in the mode yet to say June lows are something to worry about again, but you are advising clients maybe to trim in the high 4200s?
Well, actually, coming into the month, Carl, we were very vocal that we thought the risk reward was very unfavorable at that 4,200 to 4,300 level. So we were saying that was a good area to trim. Now that we're down about 10% over the last 2 weeks, what we're saying is down here we wouldn't be selling here, Carl, because in our indicators right now we're seeing the most oversold level since the June lows. And again, you've had such a one-sided move. Markets don't move in a straight line. So we still would be more on the defensive side, on the sector side, as far as like things like utilities, healthcare, staples, still like energy because of the geopolitical risk. But again, I think we're looking for some at least short-term stabilization after really a straight line down here over the last 2 weeks.